Whole lot of signals on the consumer and retail coming in today. Moments ago, Five Below announcing a CEO change and giving guidance that fell short of estimates. The stock is sinking down about 9.5% right now in overtime. And joining us now is Gerald Storch, CEO of Storch Advisors and former CEO of Toys R Us. Gerald, what happened here at Five Below? A few weeks ago, we saw that comp store sales had dropped off dramatically, even as they were trying to expand. Things had seemed to be going okay for a while, but you look at a one-year chart of Five Below, it's ugly.
Yeah, it's pretty. I mean, the stock is down more than 50% year to date, so it's pretty tough for any management in that environment. It's a good team there, and they've done a great job. Look just how much it's grown over the years. But keep in mind that they primarily sell discretionary items, and this is an environment where even though the consumer's been hanging in there, they're still very stressed by all accounts. And so discretionary items haven't done quite as well. Also, inflation, has mounted, if you add up, what's happened over so many years, to the point where it's pretty hard to offer tremendous value like they might have done in the past. A lot of the items are sourced from overseas, and you look at what's happened to the price of those or the cost. It's been hard to operate a dollar store. If you look at other dollar stores like Dollar General or Family Dollar, this hasn't been the kind of go-go years for them you might have expected, given the stress that's on the consumer.
So is this potentially a canary in the coal mine moment, given that the second half of the year tends to lean pretty heavily on some discretionary spending from consumers, and we're getting more and more signs of weakness in luxury spending as well?
Look, I'm never one to bet against the American consumer. Americans will spend every penny they have, and then more some, as is evidenced by the mounting credit card debt that we have. And today's retail sales report, for example, which shows sales for June, showed a nice beat by a couple of decimal points versus what was expected. But when you really look at these numbers year over year, and you take out restaurants and sales of things by retailers, you saw an increase of 2%. Well, we saw last week in the CPI report, inflation grew by 3%. And even though that's been coming down in terms of rate of increase, it's still underwater 3% and 2%. So what it means is even though retail sales are rising, that number is not adjusted for inflation. And so it's actually underwater. Consumers are spending more and getting less. And not only was that true for last month, but in fact, it's been true for 17 out of the last 18 months, where in fact, even though retail sales have risen, not as much as inflation. So the consumer is still struggling just to stay flat.
So you say that strong value-based players, Walmart, Costco, TJX, Amazon, are winners in these conditions. Who's especially vulnerable?
Well, anyone that sells discretionary items, as we're discussing, particularly bigger ticket discretionary items, furniture stores. You saw pretty poor numbers from the automotive industry today as well. Home improvement stores, people had really stocked up on that stuff during the pandemic when they're stuck at home, and the numbers have been increasingly negative or consistently negative ever since. So I think that's troubled. I was really pleased to see, by the way, a little uptick in apparel sales in this most recent report. And apparel has a discretionary component to it, but it looks like people are willing to spend a little bit more. Maybe their clothes finally wore out after not replacing them so many years. So apparel sales were looking good, and department stores look better than they used to, but I still wouldn't bank on that. So I would stick with the diehards that have done fantastic. Walmart, Costco, TJX is worth $130 billion. Think about that. And Amazon.
What about inventory risk as we get closer to Q4? I mean, a lot of retailers had already, I think, put their orders in. Are we going to see a lot of discounting, and should we expect some profit margins to get hit either within those strong value-based players or especially outside them?
Well, you never know, but I will say that most retailers learned a lesson over the last few years, and they're running pretty lean. If anything, they're too out of stock when you see what's going on. As far as discounting, that's been the name of the game for quite some time. Today is Amazon Prime Day. Yay! It's going to be great. Why? Because there's great value being offered. And every retailer rushed to try to beat Amazon to the punch and put all their products on sale, too, in the weeks leading up to this. So we're going to see a lot of goods sold on discount, but that is expected and already built into the numbers. So I don't think we're going to have some kind of a terrible situation this fall. I think it's going to be okay, just not spectacular. Usually, leading into election, retail sales are just fine, thank you. And I expect the same today. But I'm not expecting it to be some kind of gung-ho season.